Good morning. Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live throughout the day from Philadelphia at Nasdaq and Villanova University's Business School. ETF Synapse. Joining me for this segment, we have Eric Balchunas, is a senior ETF analyst over at Bloomberg Intelligence, as always. Thank you for joining me. This one's a little bit different. We usually come from the trading floor. Now we're coming from an academic summit.
Yeah, but the good news is it's still Friday.
Yes, it is.
Yeah,
I
always see on Fridays. Normally it's in the afternoon, so I'm a little happier.
Yes.
But it's still a Friday. At least it's not a Monday.
Yes, it is. So we typically focus on hot topics that are in the industry, whether it's Bitcoin-based ETFs trading, new funds coming out.
Yeah.
What are they focusing on from the academic perspective today?
So when you look at the academics have done a good job studying ETFs. I don't know exactly the studies they're going to present today. Last time I was at an academic event, they looked at sort of the friction inside the primary market where ETFs get created and redeemed, and they're just trying to keep an eye on sort of how ETFs are changing the market dynamic.
Right.
And I think this is something that's important because some people, when you introduce a new vehicle, especially one that trades about 30% of all the volume on the exchange, it's big time, right? You got to understand how is it changing things, how is it affecting the prices of stocks. You may also find academic studies that look at another one that I brought up in my presentation was one that found that in some cases, if an ETF is way more liquid than some of its underlying stocks, and people more leave the stock to trade the ETF, the spreads in the stocks can grow a little bit. It's not systemic risk, but the spreads growing in the stocks because less people trade it increase the cost of arbitrage, which means the ETF may trade at a little bit more of a premium. If that happens on a trajectory like this, it might not be good. So those are the kind of things academics tend to find that I have incorporated into my research, and it's very useful. But for the most part, my research is a lot more like comparing ETFs, looking at the trend of active to passive, looking at smart beta. It's much more about practical utility investment type stuff.
Right.
But the academic stuff has been really useful.
I think it's one of the reasons. I think we're also going to hear a lot about the proposed SEC rule based on the research that they've received from the academics, just because it is 30% of the market, as you were saying. So I think we'll hear a lot about that. I think we'll also hear about the kinds of data that they're using to compile their research and the quality of it. That seems to be a theme that's coming out of it. But let's get back into your wheelhouse and some of the themes that you're focusing on right now.
Yeah, and actually I can link those two things.
Yeah.
The SEC rule. One of the big parts of that rule is that make everyone present much more information on their website, like the premium discount and all this data that would really help you make a better investment decision. Now, we obviously have that on the terminal, right? But we've taken a lot of that data and made it a rating system out of it called the ETF traffic light. And what we're saying is based on what it does, how it behaves, the tax treatment, we come up with a score of how much of a nasty surprise you could be in for with this product. I think most people buy an ETF expecting it to sort of be market cap weighted, plain vanilla, track an index, thank you very much. But there's so many different kinds of products, some hold derivatives, they short, whatever, that we wanted to come up with a system, green, yellow, red, that alerted you to if there were extra things you should read the fine print on. Most of them get a green light, but there's some that are yellow that might have two things. Maybe they're alternative weighting and they have a hidden cost that you might not know about. Right. Then there's some that are red, like triple leverage.
Like the levered,
where you could lose a lot of money fast. So we feel that system dumbs down what the SEC just wants information out there. The problem with that is a lot of people just don't read it. They don't read the prospectus, they might not go to everybody's site. We're dumbing it down, we're making it easy. And if it gets a yellow, all you have to do is click and find out the two things that made it get a yellow light, and then you can go, okay, I understand that, I'm buying it anyway.
Right. So what happened in February when a lot of people blew up with the levered ETFs when we had that pocket of volatility, would this system could potentially have helped them, right?
XIV is a hard red light. I mean, that is a red light with eight checks.
Right, exactly. Yes. So if you take a look at that, you might have changed your trading practice. Well, you would like to think it does. It doesn't always mean anything, but
it's so simple. Look, it's like the movie business, right? You want a lot of movies to be made. Just because there are 10-year-olds in this world doesn't mean Quentin Tarantino should stop making movies. You just need to label it rated R. And then I know not to take my kid to it, right? It's so simple. The same thing for ETFs. Because they track everything, some of the innovation into some of the more complicated areas, like options overlays and, I'm thinking of even leverage ETFs, or VIX products, to a certain crowd, those are really useful.
Right.
They're very convenient. It's very, very useful. But it might not be useful. It's not good for my grandma to use it.
Right.
So we just need to just clearly kind of bucket that. That's all that's needed. But the problem with XIV is that it can show up in a list of, quote, ETFs, even though it was an ETN, just sitting there, and you kind of maybe think they're all the same. And that, to me, is a danger. Although XIV, it didn't have that much in assets.
Right.
The fringy stuff, just to let everybody know, if you take the whole pool of ETF assets, the fringy, rated R, red light stuff might be 5-6% of the assets.
Right. Well, it's a great analogy with the movie. Don't take your kids to a rated R movie. It's
that's it.
What else are you looking at these days? What's kind of hitting your Twitter feed?
Well, let's look at the midterms, right? The midterm election, I think we're good for ETFs and stocks in general. Because divided government's always been good for the stock market, and it kind of was what we thought. And I think that's good. I think Trump having a little bit of a check on him, but not too much. The market seemed to respond well. A couple areas to look for going forward that are popping. The first is the marijuana industry. MJ is the ticker. Jeff Sessions is out. He was like one of the biggest. So MJ popped 8% the day after the midterms. It went up 2% because of the midterms, and then 6% when
because
Sessions,
he's out, right?
Yeah, and so that took in some money. We're watching that one. That's been a fascinating area. We're also looking at biotech. Biotech's been sort of waiting for this regulatory overhang to leave, and because the Democrats didn't get too much power, I think there's less thought that there'd be regulation. And because they have enough power, Trump might not gut healthcare as much. So biotech and pharma and those have seemed to balance as well. Broader speaking, though, one area that we find a lot of interest in is multi-factor ETFs. So you heard of smart beta. It's like twisting and tilting the index.
That's so 2018, right?
I know. Yeah.
No, multi-factor's like 2019.
Yeah. Multi-factor is simple. It's people who I don't know when to use value or momentum or whatever. They do it all for you. And so those are taking in the most money out of all the smart beta factors this year. That's an interesting development. It shows that the future of active management in general is probably going to be sort of packaging your active, especially if you're a quant, into a multi-factor approach. Sort of it's an easy way to get access to those factors. Because I think it looks like investors are a little confused on wait, should I use low vol now or momentum? It can be a bit much. So that's a huge trend, and I see that continuing as well. So those ETFs are leading all of the areas. And one note on smart beta is we are seeing a lot more interest in value in general, value in ETFs. For the past 4 months, value has taken in more money than growth. And that's huge because growth beat value for a decade. And everybody's been waiting for value to come back. It looks like it might be at the beginning of that. And I point that out because as an analyst, I like to point swells out before they're huge waves. And if there's a swell right now, it's value.
Well, we wish more analysts would take that approach. But thank you, as always, for joining me. And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter.